Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. I'm really excited to talk today with Jason Wenk, who's the founder and CEO of Altruist and has been in the investment management and financial advisory industry, building client relationships and technology over a very fruitful career. So I'm super excited to welcome Jason to the podcast. Hi, Jason.
Hey, Lex, thank you so much. And it's a true honor and pleasure. I've been looking forward to this for a while.
That's very kind. But we're gonna make this about you, and our listeners and I would love to learn your journey into wealth tech, out of serving people with financial planning, financial advice, and generally improving their financial health. And if I could just start at a definitional place, how do you think about what financial advice is and its purpose?
Oh, great. Deep question to kick things off.
Yeah, easy.
So, to me, I think first, I guess I should clarify. I think there's good financial advice is transformational, helps people achieve more sort of peace and happiness with whatever resources they have, whether it's little or a lot. Financial advice isn't always good, so I think it's really key to make sure that when I think about what's possible with advice, it needs to be something that is really designed to better the end user, the customer's financial outcomes. In order to be good, it also has to be generally simple and has to be, in other words, simple enough that a large number of people can adopt it, not so specialized that it's only going to be designed for like this, really hyper narrow segment of the market. And hopefully an order of magnitude sort of obviated experience difference, meaning like it's not difficult to explain when you're getting good advice. Like it is incredibly apparent to the user. So a long-winded answer to kind of how I think about financial advice and making sure that it's good, and then defining good financial advice and what.
So to just present the silly framing, like, shouldn't I just go on the internet and the Vanguard forums and they tell me to buy some ETFs? Like, isn't that what I need to do?
Well, so there's a possibility you could find good advice there. I think there's also a larger than 0% odd, right, that it's going to be not good advice, right? Not very tailored. So obviously, I spent most of my career. I learned pretty early on that most of the people that I interacted with, they wanted to have personal advice that they could trust. And forums are generally not the greatest spot for that. Facebook comment sections probably not a good spot for that. Twitter is not a good spot. And now FinTech and all of these other sort of social media apps are also not good places for that. So it's hard for people to always know that initially. But once we have a serious enough financial problem that we really need some help, getting some human advice that maybe is augmented by a great technology is the best possible combination. So no, I would not go to a forum unless I'm looking to be entertained. But finding that great human to help you out that can also deliver a modern user experience, right? And really low cost, not scare you thinking it's going to be expensive, you're going to get ripped off or sold something. That's been a challenge for a long time. So there's not an easy answer to where you should go yet, but I would probably not go to a forum personally.
And this is one of the interesting things about the moment right now, is that for a pretty large swath of young people, and maybe also not so young people, the financial advisor in their life is a YouTube personality, or, like you say, a fintech influencer that is, let's say, generating controversial investment ideas in order to accrue attention and views for their channel, which they monetize in some way. Maybe through product sponsorships or something like that. But then people develop kind of these personality attachments to celebrities and to influencers, but none of that stuff is either bespoke or really not a lot of the time is it thoughtful, and it's not anchored to some experience that the person looking at that is really having. You kind of mentioned it's not tailored and it's not solving a problem that a person has. If we were to get like super tangible, what do you think is the job of the financial advisor? What kind of problem requires the human touch and the human solution? And maybe, in your experience, what kinds of problems did you help people with?
Sure. Yeah. And I think you framed that really well. I think, so today we just have new technologies delivering essentially the same things we've had for decades, right? So I would call that sort of like financial entertainment. And in the past, a lot of that financial entertainment maybe was dominated by television. So, platforms like CNBC. And I think, someone who doesn't know any better, it's very easy to confuse financial entertainment with financial advice or investment advice, investment recommendations. And, kind of obviously what's happened is then there's a transition to blogs and social media applications, streaming video, streaming audio, podcasts, right? Right. There's a lot of places now that you can get financial education. It's hard to tell because some of it is good, right? Some of it's not so good. And it's really, really tricky for someone to determine the difference. They give like tangible things, right? Tangible, real problems. I mean, like one that's kind of maybe a bit cliche, but is very, very real for a lot of people is that moment when they realize that they want to retire, as an example, and you get really one shot to get it right. You've saved your whole life. Hopefully, you've established a bit of a nest egg of sorts, and you decide, you've had enough. No more working for the man, and it's time to turn the savings that you've accumulated into an income you can now kind of right off in the sunset on. And financial entertainment is not your solution to get, to kind of make that choice. If you mess it up, there's no sort of second chance, right? There's no free lives. It's very, very real. And it's very intimidating and scary for a lot of people. Now, we could, bring that to earlier stages in life. If someone's buying their first home, if they're having a child, they're getting married, they're getting divorced, they're trying to figure out how to pay off a mountain of student loan debt right after either graduating or even not graduating from school. I mean, there's all these events in life. And I think in some cases, especially in America, but certainly it does happen around the world, is people are afraid to talk about money sometimes, and so it's easy to go to a digital personality, as you kind of point out, and attach kind of to what they're saying. And so, and I think there can be definitely a lot of good there. Like having more open conversations, I think, is good, but then it becomes a lot harder to to sort of uneducate someone from something that's probably entirely incorrect. So if there's obviously a trustworthy source, right, like someone who is a true, real, licensed professional sort of money guru, so to speak, and they're accessible, like that would be great. The issue for many years is they haven't been accessible, which is why I think people are drawn to these more autonomous, sort of financial entertainment complexes of sorts, which have just, evolved a lot over the last 20, 30 years.
If I could just respond to one of the ideas, I think that's really interesting, and I'm not sure if it's a bubble in which I exist, which is very possible, or whether it's more a cultural moment because of social media and the attention economy. But I feel that there's something in the air. And in part, this is reflected with GameStop and the crypto assets and Robinhood culture and stuff like that. And there's something in the air about people pretending and fronting and, acting invincible in a sense and not wanting to reveal any lack of knowledge or vulnerability and to say I don't know, or I need help with an asset allocation or with an investment choice. And instead it's this kind of anti-expert culture where rather than go to the doctor and get professional recommendations or like a real assessment, there's just the sense of complete distrust and, unless it's mine, the sort of like anarchist libertarian maximalist view, right, of any authority is bad authority. If you're an expert, you're trying to get me. And I wonder if you're seeing that at all in your journey through the world, what you would say to folks who've been kind of culturally trained to be this way.
Yeah, that's a great observation. I don't think it's just the bubble that you live in. I certainly do see that, but it's almost like for every one person I meet who's a bit of a tin hatter, so to speak, I guess, right? Like there's at least one or more people who are okay being vulnerable with what they don't know and generally looking for help. And usually it's because you reach a point, like health is a great example. we have a lot of health experts on social media these days because they read a handful of blog posts, right, or one book or something, and now they're life coaches that tell you how to eat. But when you have something that's beyond eating your vegetables, I suppose, or some fad diet, people will turn to an actual medical professional. And finance is no different. Like, I think that I hate to say that sometimes you need to feel a little pain, to realize when you need some help. But oftentimes that's the only way people learn. I mean, even from like a very early age as kids, like you touch the stove one time when it's on and you get that pain shooting through your hand and through your arm, and then it stings and you have to look at it for the blistering for days. It's amazing how good of an educator that is. And that's not that we want people to have to go through that in any form of like a difficult part of life, certainly not health or money or otherwise. But that is a part of the reality, is that we see people needing to have, sort of a self-taught lesson. And I think we do see that. That's the part that we're oftentimes where we see people who are seeking out that sort of human financial advisor. It's because they've tried a lot of the online solutions and they find they just don't work for them, right? And maybe they've made a couple of really bad choices. Maybe they've got a really painful tax bill. Perhaps they lost a big chunk of their savings, and the sort of emotional stress of having to go through that again is just more than they can take. And so, there's going to be new people every day kind of entering the phase of life where they're going to have to choose a path. Am I going to do it on my own, or am I seek help? And that's totally okay. A lot of people actually can be very successful doing it on their own, but not all, right? Some people go through that painful moment. And it's a very big world. There are a lot of people, and there's no one size fits all solution. Not everybody should have to feel obligated to go through a human financial advisor, work with that bona fide expert, so to speak. But certainly many tens or hundreds of millions will and should.
Yeah, thank you for that. I really wanted to open up that discussion of the emotional labor that is at the core, I think, of what good financial advisors do. And at this point, a little bit of a framework from a while ago, but in my mind, I had three archetypes for RAAs, and that was, one is the behavioral therapist, the financial therapist that really is largely guiding people through decisions and being there for them, and kind of wrapping around the mistakes that people are likely to make. And then, the second one is the portfolio management piece and doing investment selection and really focusing on investment selection and building out investment strategies or asset allocations. And then the third is distribution. So, product sales. And I think it's very hard to tell in the wild for folks who they're interacting with, and what type of value they're getting from their counterparty, especially from the larger firms that are very product centric, and as well as the technology firms that are very product centric. Can we maybe use that as a jumping off point to your experience with retirement wealth and FormulaFolios, and how did you go on that journey? What was the evolution, and how did they interconnect?
So I'm going to give you a slightly longer, kind of time warp. But I started off in the industry as a financial engineer, and I had no intention of doing anything with personal advice. So when I talk about like the different paths people take where they want to do it on their own and use the internet to kind of find solutions, I built an application. Crazy to think it's been like 15 years, so it predates really most of, certainly every app, because there was no app store back then, and predates most of the online financial advice that you might find, or services, robo advice and so forth. But it was a solution designed to help people with their 401k. What happens? I'd spent some time at a major global investment firm, and I felt like the things I was doing weren't helping real people, sort of the regular people, which is people I thought of myself as a regular person. I'm from a small town in Michigan, so I thought, what does everybody I know have? Even if they're a blue collar worker, a farm, employee, a scientist, an engineer, whatever. I thought, what was a 401k? So what if I came up with a solution that it's almost like financial engines before financial engines, but not nearly as sophisticated, but it was really simple. You could kind of come in, go through a risk questionnaire, kind of goals questionnaire, identify where you work, and then it would help create a 401k recommendation. And then on a monthly basis, send you an email to let you know if there are any changes you should make. Right, so very simple. It was a subscription service. Back then, it was very easy to market online. Like there was almost no advertisers on, Google AdSense, AdWords. Those were like brand new. Actually, Google wasn't even the primary ad location. I was running a lot of things in Overture back then to kind of show my age. But it was really inexpensive, right? Just pennies, per click. And so you could drive people to a site that sort of says, hey, if you're looking for help with your 401k, here's a quick, easy service, right? $20 a month or thereabouts. Free trial. Click here to get started, right? So So that was a really good learning journey. I actually had, many thousands of customers, but what I learned there was my average customer churned out in about 9 months, right? So for those who built consumer applications, that's not a very good customer lifetime. And the main reason that people would leave was they said, well, one, it would be, hey, you're not giving me any new advice, right? Because a lot of times the algorithm would say, hey, your allocation's okay, don't make any changes. And it's like people are like, why am I paying for something that doesn't do anything? Even though that was the right thing, sort of empirically for them, they felt like there should be more, like trading or something like that happening. And then the second part was, hey, I just don't have the time to even go log in 5 minutes and do it on my own. So if you just did it for me, I'd pay you a lot more money. So I thought, okay, maybe I need to find out a way to give personal advice. And what I learned also was that the average person using that service was, for the most part, the majority of them were baby boomers. And mind you, this was a baby boomer 20 years ago. So a lot of them were like still 40s and 50s, but they weren't like other 20 somethings. I was in my early 20s at the time. I thought it would be people like me, but it wasn't. It was people that were, 20 years older, and they were looking for help and advice with their 401ks, right? So that's how I started Retirement Wealth, which was my first ever registered investment advisor. I didn't even know what that was at the time, right? I mean, I had to do research to figure out how you even start a firm to give people advice. There were very few RIA firms in the United States, and I think, maybe a couple thousand back then, or a few thousand. This was 2004. But that was my kind of path into personal advice. And then I leveraged a lot of the same learnings from that sort of subscription service, which was, driving a lot of the demand through direct response, a lot of online marketing. I was a very early financial blogger. So, I used the same tools that I was kind of poking a little fun at today, as ways to acquire customers very inexpensively, right? Because it was primarily free. It was just content. Developed a YouTube channel very early on, and used the YouTube content along with SEO, right, to drive a lot of traffic. And we built a pretty successful wealth management firm that primarily served clients virtually all over the country. And this was over 10 years ago, it's almost 13 years ago now. So it's interesting. So that was a great learning experience. I learned about sort of how to do all the things that a financial advisor would do, but I certainly wasn't trained to do that. I didn't study at school. I always viewed myself as an engineer that just solved problems. And in this case, the problem solving led to forming a registered investment advisory firm, and learning financial planning and a lot of other kind of interesting, kind of skills. The pivot from there to FormulaFolios. So FormulaFolios would have been my next company. I started that in late 2011 and launched it in 2012. And basically the genesis to that was I started having other financial advisors come to me. I was fortunate enough to speak at a couple of conferences where I was able to kind of share my story of using the internet to, and this was today there's probably a lot of people talking about how they use the internet to grow their business, but it was such a foreign concept pre 2000, I don't know, like 15 really. I mean, certainly pre 2010 there were just not many financial services people doing this well. So I got a slight bit of my 15 minutes of micro fame, if you will, and started having people reach out and going, how can I plug into this? This is the future. How do I plug in? And I thought, well, the economics, as I started to evolve as an entrepreneur, I realized that building a direct to consumer platform with human advisors, even heavily digitally driven with a lot of proprietary digital tools, which I wrote most of the code myself for all of our kind of back office tools. The cost to scale that up, I thought, was going to be really, really challenging. And right around this time was when Betterment and Wealthfront and a number of kind of robo advisors started popping up. And I could see what they're doing. And I actually, in my mind, I sort of thought, I think they're going to eventually run into some really high, CAC issues. Like the cost of acquisition is going to be really tough. Really cool technology they're building. I was really a big fan of kind of like the vision there, but I just thought, maybe a smarter play is more B2B2C. I'm going to work with existing advisors, arm them with technology, help let them sort of, take a lot of the burden of servicing the clients as independent 1099 contractors, because they have their own independent advisory firms. We'll let them actually pay for their own direct costs of marketing, just but plugged in through sort of an ad tech platform that we sort of built out, augment it with a lot of SEO and sort of digital content marketing, and grow it that way. I thought it'd be a much more efficient, use of capital. It turns out I was right on both fronts. I mean, those two companies and others have become very successful, and so happy for them and the people that helped build them, and the change it's kind of brought to the industry. But FormulaFolios was really just, it was a platform for advisors. It did two things. It helped them automate their marketing and helped them automate their back office. We built a lot of our own tools and then used some external tools. To where I first crossed your path, seeing some of the things you were doing at one of your prior companies, Advisor Engine. And so it was a really good run. So I did that for 6 years, 2012 to 2018. Built a very successful business, growing very, very fast. And it was very profitable, which is kind of one of the things that is not common in fintech. That it only took me 2 years to turn it profitable, and then its net margin, operating margin was quite excellent compared to really any other consumer fintech. So it was a great learning experience.
And what was the, I don't know if this is a big secret, but what was sort of the operating model for FormulaFolios that it made money rather than burn money?
Yeah, so the big thing was that we didn't have the really high COGS, right? So when you think about the cost of goods sold, think about it this way. So we would get a financial advisor, a typical customer for us, we would actually go very low end of the spectrum in terms of like their assets. And because we were solving this sort of like, how do I grow a business challenge. So a lot of our users would come in, they'd only have like $5 or $10 million of client assets, which is very small in the financial advisor space, where a lot of advisors are managing 100, 500 million or more. And so these people were very growth focused, if you will. And so for us to acquire that customer was very easy, right? Because our offer was, we essentially solved their biggest problem. Their biggest problem was, I only have $5 or $10 million. How do I get to 50 or more and build this into a real sustainable business? And we'd say, okay, we'll plug in here, like, let us show you the way. And we had a ton of success stories. So we could acquire an underserved advisor. But what's interesting is, like, to acquire that advisor for us was around just a hair under $600. And for anyone who's ever worked in fintech, especially on the growth side of fintech, and you're trying to think about acquiring B2C customers, if you're spending $600 to pick up a $5 million or $10 million end client, which was a sort of the financial equivalent of what we're doing, I mean, it was an incredible flywheel. Like, it was very, very inexpensive. So I never had to raise outside capital. I built a company with $100,000 of my own personal money. So very inexpensive to scale it up. And then those advisors, they took on almost all of the actual, customer service. So we had a modest, 10-person CS team and an annual marketing budget under $200,000. Yet we were producing close to 60 million in ARR. That's unusual, but we didn't have very high COGS because the COGS were actually mostly the advisor. So the advisor would come when we'd plug in, we'd say, well, what's your budget, right? They might say it's $2,000 a month or whatever that number might be. We simply deployed their money. So we didn't use our own capital because the advisor was one who owned their own business, right? They were sort of, again, that independent contractor, if you will. So it created a really interesting economic model. I mean, we then participated in the growth of their business. We charged basis points. So, a portion, anywhere from 0.2% to maybe 0.5%, depending on, the type of accounts that they had and the size of their business. So we had a incredible, sort of net revenue retention because these advisors were growing, many times doubling their business annually for their first 4 or 5 years. So it was a pretty interesting sort of mousetrap, if you will. But yeah, I've never had a problem sharing the economics, but they were unusually attractive.
Yeah. So if I play it back to you just to make sure I understand, so something like 20 to 50 basis points, and really putting in, I guess the service is practice management and a guidance for advisors in terms of how they should behave in terms of growth. Like, did you integrate them into a bunch of portfolio management and custodians and do asset allocations, or how was it overlaid on top of their practice?
Yeah, so we built our own advisor portal that was their kind of hub by which they could control things like their marketing. Again, sort of the two prongs that we would help solve would be this sort of, how do they grow? And right, so part of that was education, but we did that almost entirely digital. We had a digital portal where they could go through pre-recorded video training. We do occasional live events where they could come in and get live training, but it was designed to be, how can we scale this? Like, how, we can't do one-on-one coaching for 5,000 financial advisors. It just was impractical, it'd be too expensive. So how can we digitally deliver sort of at scale the advice and to the advisors on growing their business? But Then we had this really kind of cool ad tech platform where we could manage marketing campaigns for, an infinite number of users sort of at scale with a minimal amount of work on our end. We essentially built, a number of direct response campaigns. So everything from like a Facebook ad, right, to a landing page that then goes into an email sequence and has 15 different CTAs spread out over 6 months or whatever this level of sophistication might be. These are things that an advisor should not be wasting their time trying to do on their own. But if you're working with a network and you get a bit of a network effect, what we're able to do was get the advisors to all be part of a large nationwide, multi-million dollar, online advertising campaign. But it was set up in many ways like an affiliate marketing campaign. So they would get credit, and any leads that came from their activities would go to them and allow them to build their business sort of in whatever geography made the most sense. Once they had those clients, then our platform built out portfolio recommendations, asset location, would build out a full investment proposal. We had built digital account opening way before most people had done digital account opening. And I shouldn't call it digital account opening. We digitized PDFs before other people digitized PDFs is probably a better way of putting it, because that's all that the custodians would support. And yeah, we definitely had a reliance on some tech vendors and some custodians. And ultimately, what I learned was this was the biggest challenge with that business. Like, why the reason I didn't just scale it up into some multi-billion dollar, sort of juggernaut, if you will, is that it had way too much reliance on downstream vendors. And those downstream vendors had very antiquated processes, a very antiquated view of technology. In many cases, they had so many conflicts built in with their own sort of primary vendor relationships that I could see that there was no way to really provide that like obvious immense value to the end client. Like, we were always going to have to charge more than I wanted to. And we were always going to have some issues with scaling because there wasn't sort of proper infrastructure to support financial advisors. No matter how big our engineering team grew and how many dollars we reinvested back into our own platform, we still had way too much reliance on, again, these, sort of antiquated ways of doing business that hadn't changed for, many, many years. And meanwhile, I was looking around us and watching Robinhood and Betterment and all these, companies build really efficient technology. And I'm going, advisors are just being left in the dust. We have to find better ways to do this. And relying on some form of, 50 or 100-year-old sort of custodial vendor was probably a bad idea. Like, we weren't going to be able to like rub that genie lamp and get much to happen.
Just to share my own experience on a similar journey, you've got an insight in there that is super, super valuable. So for me, I came from the wealth management industry in the Lehman Wealth business in a strategy team. And, the insight was very much along the lines of the storefront for financial products is human in 2008, and the storefront for financial products in 2018 will for sure be on the internet and in the phone. And I think that insight has driven a lot of innovation and outcomes in lots of different ways, whether it's robo-advisors or neobanks or digital investing or digital transformation of advisory businesses or hybrid advisory businesses. It was there for everybody to see, but it was very hard to act on. And in part, what you're describing is a really hard-earned lesson for folks trying to build on this custodian third-party portfolio management infrastructure. And so, with Nest Egg, the B2C robo-advisor that I started building out, there was a lot of focus on onboarding, risk assessment, asset allocation, financial planning, and getting the business process of what an advisor does, not the emotional work, not the selling, going back to those three archetypes, not the distribution and not the emotional work, but the actual asset allocation, nuts and bolts of the mathematics, automating that. And one can do that a little bit, or you can do it all the way with every single process. You can figure out the cash flows in retirement for whether they can asset location, as you said, and all these extremely hairy things. But you're still left with a problem, which is, number one, you need to connect your recommendations to products, mirroring the point about sending a spreadsheet isn't sufficient because people don't want to do the work. They want the work done for them. And so you need to connect to product. but that product lives in a horrific dungeon of wires and broken bones, which is the capital market system in the United States. So if you look at the entire value chain, you start with what is a stock, and it's what is the DTCC, where are the things actually owned and settled, and then it goes up to exchanges, and then it goes up to custodians and broker dealers on top of that, and then you get to the RA custodians. And then on top of the RA custodians, you have lots of intermediating software. And then on top of that, you have RAAs, who register investment advisors, who have completely disorganized and different technology stacks because it's a plethora of apps built over 20 years. And then you're entering that conversation as one more vendor. And so I think one of the challenges that advisor desktops have faced, like Advisor Engine for sure, is that both it is expensive to do these integrations, to reach inside of Fidelity and Schwab and NTD is lots of data reconciliation work, which is in part why I'm obsessed with blockchain. And then number two is, if you are part of that mosaic of all the other stuff, which you have to be because you've got account opening and financial planning and performance reporting and fees and billing and CRM and the other CRM, and alternatives and now crypto, and all of this stuff has to connect. Even in the case where the advisor has lots of wallet to pay you out of, which of course they don't because they're extremely fee sensitive small businesses, your gross margins are awful since you're paying out every integrated provider that's inside of your advisor desktop. So this is a really, really difficult challenge. And I think what struck out as a thing that you did right and I did not was the focus on revenue generation, because going again to those three archetypes, it's super important to actually drive business. And it's not just about making people more efficient or giving them time, but it is about solving the core issue of getting more assets. And I think that's a really key insight, that attaching the marketing platform and understanding how to acquire customers for advisors is going to be kind of an order more in magnitude value added to these small practices, and it generates their willingness to pay because you're actually bringing them, you're doing the hunting for them. And I think that's really interesting. So welcome to respond to that thought dump, but also would love to see how you took these insights and then how you're kind of untangling this knot with Altruist and thinking about custodians.
Yeah, so yeah, it's funny. We didn't know each other back then, but I think we probably were doing a lot of the same head scratching, trying to figure out like how do we, because I think our timing was quite similar in terms of like these build on top of and around of custodial limitations. But for me, interestingly, I think probably around 2016 or 17, the writing was clearly written on the wall to me. I realized that I was either going to need to, and I'd already went through, at my last company, I built an integration with Apex Clearing. So I, went through like the practice of digitizing sort of in a way not dissimilar to many modern robo type platforms, account opening and trading and some things. And we were gaining some efficiencies there. But it became very clear to me that needed to be like a standalone solution. FormulaFolios was almost over bundled. Proprietary portfolios, proprietary marketing, sort of proprietary financial planning process. So if you were an independent advisor, I mean, you really had to make a wholesale switch. And certainly, again, people were willing to do that, but they were typically willing to do that if they were early in their career and hadn't already established, maybe a decade of like their own version of best practices. So what I thought made a lot of sense was, wow, what if there was just, and oddly going way, way back, when I started that first RIA in 2004, I couldn't even get a, call back from Fidelity and Schwab. But there was one custodian who would take a chance on me, and they were called TD Waterhouse back then, then TD Ameritrade, and now part of Schwab. But they would work with newer, smaller startup firms. But I still remember asking them pretty vividly, like, okay, cool, like, you guys will take me on, like, okay, now how do I open accounts? Like, how do I do billing? Like, how do I do trading? And they pointed me to an affinity center on their website that had like all of these third-party vendors. And that was like when I was like, whoa, there's this whole world of advisor technology. And you'd have to spend a lot of time and effort to really figure out how to put those pieces together, especially if you were like a one-person shop. Like that was spending a lot of your day doing non-financial advice giving. And I remember just asking, like, why would you guys not just do this on your own? Like, this makes no sense. Like, the data is already with you. Like, why wouldn't you just do the fee billing? Why wouldn't you just do the performance reporting? You literally have the data. Like, well, it made no sense that you'd have to take their data, dump it into some data warehouse to then unpack it and hope that the portfolio accounting platform would, have like a, proper like canonical data modeling and be able to, have a security master that actually translated the holdings and the QSIPs into the actual names of the holdings. It just seems so bizarre to me, right? That a custodian had all the information, but they would send you this bizarre, CSV file in some bulk SFTP format, and then you'd have to unpack it and hope that it worked, and then pay another company for it, which just seemed like the dumbest idea in the whole world. And so 14 years later, it still was operating that way, and I was like, like, let's rebuild custody. Like, this is what needs to be rebuilt. And if we had to do it all over again, I don't think people would ever do it that way, where like, okay, the custodian's going to send a data file over SFTP, some flat file. They're all going to use slightly different file formats too, of course. So that way, these portfolio management or accounting systems are going to have like, again, like this sort of canonical modeling where they can take in data from 5, 6, 7 vendors and translate it into one coherent, sort of front end. I was like, why won't we just do it native? Like, let's just build it from scratch. Just do it the right way. Right. So Altruist was born really to give advisors a fighting chance to be relevant, not just today, but 10, 15, 20 years from now, because, I was on the advisory boards of some of these big companies and even some of the larger fintech players serving advisors. And I just didn't see it happening. And there was so much going on under the hood that people didn't realize in terms of bizarre soft dollar arrangements that, kind of made firms not really want to compete. So if you were a software company and you were getting fed tons of referrals by your custodian, and then also, the custodian was paying, again, sort of these soft dollar payments back to the software vendors for their biggest customers. And it reminds me of, like, if you ever saw the documentary like years ago on Netflix, it's called Who Killed the Electric Car? But it reminded me of that, like, where it's like you had electric cars 30 years ago, and for who knows what reasons, right? Some type of conspiracy theorist type reasons, right? That they were killed. Was it the oil companies? Was it the car manufacturers? Was it the dealers because they didn't have as much maintenance on who knows? But the point was simply that, like, this was kind of what was happening in our spaces. There was all these different parties. It just seemed too dirty, and no one wanted to be the killer app, so to speak. It just didn't make sense for the custodians to do it, and certainly nobody wanted to rattle the cage if you were a fintech vendor heavily reliant on the custodians. So that's kind of how the idea started. It took me about a year and a half to really commit and then pull the trigger. I started Altruist in 2018, and the vision is not to necessarily be the killer app, so to speak, but it's just to do it the way it should have been done if you had to reinvent it. Like, if you take any great product leader that's not from our industry, and if you showed them how products are built in our industry, they would just be scratching their heads. This makes absolutely no sense. So if you didn't have all of this sort of legacy, like whether it be legacy ways of thinking or just actual legacy technology, like, how would you build it from scratch the right way? And that's kind of how we thought about Altruist. And so it's, in many ways, the most simple basic things, like, you shouldn't have to, it shouldn't be hard to open accounts with a financial advisor. Like, they shouldn't send you a ream of paper, and you shouldn't have to get medallion stamp signature guarantees. And you shouldn't have to have no idea what's happening, like, in your account opening status. There's a term that, you and I know, Lex, but maybe not everybody knows, but they call it NIGO. It's an acronym for not in good order. Like, that shouldn't even exist, which is what happens almost 20% of the time when advisors send in paperwork on behalf of their clients. And not just account opening paperwork, but like supporting, trades or money movement or beneficiary changes. Like, those things are still paper processes for most platforms. So the vision was simply taking all of those common actions, like digitizing them, making them really modern, beautiful user experience. At its core, that's sort of the phase one of Altruist. Similar with like trading, why do we have to use whole shares? Right? That's such a silly, archaic way of building portfolios. Well, a theory I have is whole shares make a lot more money for the big custodians because you end up having more cash in your cash accounts. Anyone who's ever looked at quarterly report from a publicly traded custodian, you'll see that even in a 0% interest rate environment, it's a massive amount of their earnings. When rates are a little bit higher, it's 50, 60, 70% of their earnings is just the credit interest that they make and spread that they make. So why would they want you to buy fractional shares where you could have, as little as 1% in cash, when by making it difficult for you to buy whole shares of financial products, you might be at 5% or 10 or 15. Or we saw one of the latest, regulatory fines. Some platforms were actually putting people 10 to 15% in cash, telling you the service was free, but using that large cash position to earn their revenue. The regulators didn't like that and fined them for it, of course. But these are the practices that like we felt like they shouldn't exist, and we wanted to make it really, really easy for advisors to actually do their best work. And if they're a lot more efficient, they'll serve way more customers. They won't be limited to like 100 or 150 people. If you're limited to 100, 150 people, you're of course going to have high minimums or high fees or both. If you can create these order of magnitude improvements in, again, account opening and servicing and trading and rebalancing, you can serve 2, 3, 5, 10, 20 times as many clients and do better work for them. When you start thinking about the power of machine learning and AI, you can automate great behaviors. So you can sort of give an advisor true superpowers to ensure that things like really proper tax management is applied to all client accounts, which can yield huge results. I saw a report from one of the major rebalancing software companies that reported their 2020 average increase in return for their customers was 1.88%, just because they used proper tax location, tax loss harvesting, and rebalancing. These are material things, but a lot of advisors don't do these things because they don't have the tools, or their custodian won't support them in an efficient way. So a very long-winded response, Lex, but that gives you some insight into the journey to form and start Altruist, why, and kind of what we're building right now.
Absolutely. I have so many questions, but we're coming up on time. I've got, I think, two that I wanted to seed and see if you've got maybe a quick take. And the first is, what has changed over the last 5 years in wealth tech? What are some of the step changes that you've seen that you think put Altruist in a place to do these improvements that maybe the building blocks weren't there before? And in part, that's also a question about, industry structure and Apex and the broker dealer, and sort of like how vertically integrated do you think the right answer is, in the sense that, the past solutions really were trying to be on top of things, and now we're getting much more vertical.
Yeah, I think that's a great observation. I would say that, so one of the big limitations of the past is that I think, for better or worse, I think it's really important to have significant financial backing to build highly disruptive companies. What we're building, I can assure anyone who wonders, it cannot be built by two Stanford, grad students in their garage, right? Like, these are, to really build a highly integrated B2B2C platform, that's more than just a point solution. It requires tens of millions of dollars, $100 million. I mean, these are not inexpensive endeavors. You also have to have a lot of domain expertise. And so, for a multitude of reasons, until recently, it was difficult to get access to the capital to build these really, again, highly disruptive solutions. In the past, most solutions were, an advisor that had sort of an itch. They wanted to scratch it. They built a point solution to solve one pain point within their practice. They'd get a couple hundred users. They'd build a relatively, successful lifestyle business, but these weren't things that were of interest to venture investors. And it's because of a lot of the successful consumer facing fintechs that we now have access to capital to build really disruptive tools. In so many ways, I'm really grateful, that those, John at Betterment and the team at Wealthfront, like, that they took some of those early risks and were able to, sort of prove out certain things that could be done on the wealth management side. But the other part, I think, that's a challenge, for advisors is actually for advisor technology specifically, is that you have to think really big too. Most of the best investors aren't interested in small ideas. So, if someone has a small idea that's maybe like, let's call it a modest CRM application that's going to maybe have 30 or 40,000 users and 10 million of ARR and, whatever, maybe a million of profitability at some point, like, that's not that exciting. Even though it's necessary, needs a lot of work, it's not going to attract, kind of the significant dollars that might be necessary to build a really, really, again, disruptive in a good way, technology for advisors to use. So fortunately, like things that have happened, I think Apex has been great for not just advisors, but I mean, the entirety of any wealth management technology. I think the work that they did was incredibly important, going way back to the Penson sort of rescue. I think that companies like my last company, I mean, they proved that there were some incredible economic levers in B2B2C that helped, underscore kind of the potential of building better tools that could grow even bigger and faster. And then in general, the market's for, again, better or worse, it's a bit frothier these days. There's a lot of capital, that's available. So if you have a great idea, and if you're an ambitious founder, if you have substantial domain expertise combined with maybe the right either technology or product expertise, this is a great time to go innovate. And who knows how long this will last? But I'm really grateful that the timing lined up well for me. I've been doing this for 21 years. 10 years ago, version of me couldn't have done this. And not just because of my limitations, but because the markets were different in terms of the ability to raise capital. The technology infrastructure and partners, it didn't exist then in a way that they could have supported the sophistication of an advisor's business needs. So yeah, lots of reasons why it hasn't happened, and lots of reasons why right now is a really great time for people to be building really big, meaningful ideas and companies.
Awesome. Really, really thoughtful answer and conversation. Thank you, Jason, so much for joining. Where should our listeners go to check out more about you and Altruist?
Yeah, so we'd love people to just check out online. Altruist.com is our website. Our Twitter handle is @altruist. I think you'll find us @altruist on most social media platforms. So keep an eye on what we're up to. We have huge plans for the balance of this year and next. Really excited about our team. We're about almost 160 people now, just hell bent on doing better for the industry, making advice better, making it more affordable, making it more inclusive. So follow us wherever it's most convenient. We have a killer podcast too, Human Advisors. So check that out. And if anyone's interested in my musings, you can follow me on Twitter. Mostly is where I hang out. It's @Jason Wenk, and not a scary follow or mean commenter, but love to lurk in specifically fintech and advice tech.
Awesome. Thanks again for joining the podcast.
Yeah, Alex, it's a real pleasure. Thank you so much.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.